You're listening to the Bare Metal Cyber Prepcast, created to help you succeed in your PMP certification journey. Learn more at baremetalcyber.com, where additional prepcasts, books, and training materials await. Let's get started. Financial services projects operate in an environment where trust is guarded through controls, evidence, and regulatory compliance. Unlike consumer tech or manufacturing projects, where failure might mean rework or lost revenue, a failure in financial services can mean fines, reputational damage, or loss of customer assets. That is why controls, contracts, and audit trails are at the heart of every decision. For a project manager, this means you must not only deliver outcomes, but also ensure that each outcome is defensible with evidence. Finance requires a dual lens: value creation and control adherence. PMI's expectation is consistent analyze impacts, follow the control path, use the contract mechanism, and produce auditable evidence. The key artifacts in this domain reflect that emphasis. A. Controls matrix maps regulatory requirements like SOX or PCI-DSS to system checks and tests. A risk register tracks operational and compliance risks. Contracts and statements of work govern vendor obligations and remediation paths. Vendor due diligence files, often part of third-party risk management (TPRM), provide ongoing assurance that partners meet standards. Change logs ensure scope adjustments follow formal approvals. Settlement and reconciliation procedures prove that money moved is money accounted for. Each artifact is not just documentation. It is an assurance mechanism that auditors and regulators will test. The first scenario involves PCI-DSS, the Payment Card Industry Data Security Standard, which governs cardholder data protection. The team proposes storing partial primary account numbers or PANs for troubleshooting. On the surface, storing just part of the number might seem safe, but any storage of PAN data triggers PCI scope and increases audit obligations. The professional response is not to accept the shortcut, but to analyze the impact on PCI scope, and then adopt solutions such as tokenization or truncation. Data flow diagrams must be updated, and evidence must be captured to show that no sensitive data is retained outside approved boundaries. The options in this case illustrate typical shortcuts. Approving and masking later is non-compliant. Denying all logging ignores operational needs. Exporting to spreadsheets temporarily creates uncontrolled data copies. Only option B, impact analysis, followed by tokenization or truncation, with updated data flows and evidence aligns with PMI's principles. It balances operational value with regulatory protection. The artifacts that are updated include data flow diagrams, access control lists, and the logging policy. The heuristic to remember is clear: reduce the scope of sensitive data and prove the control path through evidence. The pitfalls in PCI-DSS scenarios are predictable. Shadow copies of card data appear when teams export to personal spreadsheets. Uncontrolled exports undermine access controls. Temporary shortcuts become permanent liabilities. PMI's exam often tests whether you recognize these as traps. The correct instinct is always to limit sensitive data exposure, enforce approved tools, and leave behind an evidence trail. Projects in finance succeed not by avoiding logs, but by ensuring logs show compliance. Evidence is not overhead. It is protection for both customers and the organization. The second scenario tests your handling of SOX, the Sarbanes-Oxley Act, which requires strict controls over financial reporting. Imagine a release where segregation of duties failed. Perhaps the same person both coded and approved a change. The pressure might be to ignore it, since the release already occurred. But PMI expects you to document the control exception, implement a compensating control, and remediate the process to prevent recurrence. Evidence must be prepared for auditors so they see transparency, not concealment. Responsibility means owning the lapse. Integrity means documenting it properly. The options here reveal the cultural pressures. Ignoring the issue creates audit exposure. Rerunning the release silently is dishonest. Blaming the vendor avoids ownership. The professional move is option B. Record the control exception. Implement a compensating control, perhaps through post-release peer review, and remediate the process. The artifacts updated are the controls exception log, the remediation plan, and the evidence file for audit. PMI's exam will reward answers that show transparency plus corrective action, not concealment or blame. Controls sometimes fail. What matters is how you handle the failure. The third scenario brings in vendor risk through TPRM, or third-party risk management. A vendor's SOC report Service Organization Controls report arrives with material findings just as contract renewal is pending. The options span extremes: renew blindly, terminate immediately, or ignore. The discipline path is to perform a risk assessment, negotiate a remediation plan with enforceable service-level agreements, and allow conditional renewal tied to progress. PMI expects you to recognize that termination without analysis may harm value, while renewal without remediation exposes risk. The middle path documented corrective action plus conditional renewal is both practical and compliant. Artifacts in this scenario include the vendor risk assessment file, which records the findings, the contract, which must be updated with remediation requirements, and the SLA monitoring log, which enforces commitments. By documenting the risk and linking it to contractual obligations, you protect both the organization and the relationship. PMI expects you to see vendors not as infallible partners but as risk-bearing entities whose compliance must be managed transparently. Evidence here is not adversarial, it is collaborative assurance. Vendor risk spikes are common, whether from SOC reports, data breaches, or missed SLAs. The traps are also common: renewing without addressing findings, waiting for the next cycle to fix issues, or ignoring them altogether. PMI situational questions may frame these temptations as options. The correct path is always to assess impact, enforce remediation through contracts, and record evidence. Third-party risk is not solved with trust alone. It is solved with controls, obligations, and transparency. In this first half of the lab, we have seen PCI DSS handling of card data, SOX control exceptions, and vendor risk spikes under TPRM. In each case, PMI's framework was consistent. Start with impact analysis, follow the control path, use the contract mechanism, and capture evidence. Shortcuts, such as raw exports, ignored exceptions, or blind renewals are always traps. Ethical and professional project managers formalize decisions, update artifacts, and leave an auditable trail. That is what regulators, auditors, and stakeholders expect in financial services. For more cyber-related content and books, please check out cyberauthor.me. Also, there are other prepcasts on cybersecurity and more at baremetalcyber.com. The fourth scenario highlights anti-money laundering, AML, and Know Your Customer, KYC requirements, which are fundamental in financial services. AML and KYC rules require financial institutions to verify the identity of clients and monitor transactions to prevent illegal activity. Imagine a regulation that now requires an additional field to be collected during customer onboarding, and your launch is scheduled in 3 weeks. Some stakeholders suggest ignoring the change and adding the field later. Others propose delaying the entire quarter. Integrity and compliance demand a more balanced path. Conduct a rapid impact analysis. Design a minimal compliance slice that includes the new field. Update procedures and training, and capture the evidence trail. The options show predictable traps. Option A, ignoring the requirement, is non-compliant and creates legal exposure. Option C, delaying by an entire quarter, may be overkill if a compliant slice can be delivered sooner. Option D, accepting a verbal exception, is inadequate because regulators do not recognize verbal agreements. The correct choice is option B, rapid impact analysis, minimal compliance slice, updated procedures, staff training, and an evidence record. PMI expects you to demonstrate that compliance is embedded into delivery rather than postponed. By documenting compliance immediately, you protect both customers and the organization. Artifacts in this AML/KYC scenario include updated onboarding procedures that reflect the new field, training records that prove staff have acknowledged the change, and the compliance register that documents regulatory alignment. Evidence should also include communication updates to stakeholders and customers explaining the field's purpose. By updating these artifacts, you ensure the change is traceable from requirement to training to release. PM. I will always reward answers that preserve compliance without unnecessary paralysis. The heuristic is clear. Compliance slice first, validate it, and leave a trail of evidence. When an incident occurs, it is tempting to send quick, informal updates, but PMI expects you to resist. Instead, you record the event in the incident log, initiate corrective and preventative action, CAPA, and ensure all communication is documented. By doing this, you create a record that auditors and regulators can review. Customers may not like the fact of an incident, but they respect timely, truthful updates that explain the issue and outline steps taken to resolve it. Integrity is not about perfection. It is about consistent, transparent handling of issues. The sixth section highlights evidence and reporting. In finance, evidence is the heartbeat of compliance. Every control test must be documented and linked to specific releases. Dashboards for audit readiness must be kept current and accurate. Vendor attestations, such as SOC reports or remediation proofs, must be stored centrally. All approvals must exist in one official source, not scattered across email threads or chat tools. PMI expects you to see evidence as part of delivery, not an afterthought. Without evidence, controls are invisible, and invisible controls may as well not exist. For example, when a control requires dual approval for a release, the evidence must show two distinct approvers captured in the official system. If one approval is given verbally or logged outside the system, the control is broken. Similarly, if a vendor promises remediation but provides no proof, the control is incomplete. Evidence must be auditable. It should stand alone and convince an external reviewer. PMI situational questions will often test whether you recognize the difference between "we know it happened" and "we can prove it happened." Only the latter satisfies regulators. Common exam pitfalls mirror real-world temptations. One is reliance on verbal approvals. These are always inadequate. Another is using spreadsheets to store or share cardholder data. Spreadsheets are rarely controlled or monitored, and they create shadow systems outside PCI-DSS scope. A third pitfall is missing segregation of duties, such as allowing one person to both initiate and approve a transaction. Yet another is waiting until renewal to fix open vendor risks. PMI expects you to see all of these as traps. The heuristic remains: control first, convenience second. If you see an exam option that suggests convenience over compliance, you should reject it. A sponsor may argue for speed, but PMI wants you to prioritize control integrity. Controls are what protect customers and prevent systemic risk. Convenience-based shortcuts erode trust and create liability. On the exam, look for options that increase transparency, strengthen evidence, and align with policy, even if they appear slower. In reality, they prevent costly rework and reputational harm. To consolidate, let's outline a quick playbook for managing financial services projects under regulatory and vendor risk. First, start with control mapping. Align requirements such as SOX, PCI DSS, and AML KYC with control tests in your project. Second, conduct impact analysis whenever changes arise. Third, enforce contract mechanisms and TPRM obligations with vendors. Fourth, capture evidence diligently, from approvals to control tests to vendor attestations. Fifth, deliver minimal compliance slices to meet deadlines while maintaining protection. Sixth, keep customer protection at the forefront of every decision. Seventh, maintain an audit-ready trail that proves compliance. The playbook also includes training and monitoring. Staff must be trained continuously as regulations change, and training records must be complete. Monitoring systems must be in place to detect control failures quickly. PMI expects you to understand that compliance is not a one-time task, but an ongoing cycle of training, testing, and evidence. By embedding this into your projects, you demonstrate professionalism and protect long-term value. The cultural takeaway from this lab is that in financial services, integrity is measured by consistency. What you say, what you do, and what you record must all align. Customers, regulators, and vendors do not trust promises. They trust proof. When your projects deliver both outcomes and evidence, you build resilience. Regulators may accept honest exceptions paired with CAPA, but they will never accept hidden gaps. PMI situational questions will test whether you instinctively choose transparency, control, and evidence over speed and convenience. The closing reflection is that financial services project managers operate under a dual mandate: deliver business value and protect the financial system's integrity. SOCOS enforces controls and reporting, PCI DSS protects cardholder data, and AML KYC ensures customer transparency. Vendor risk adds another layer, requiring contractual enforcement and evidence. By applying PMI's consistent rhythm impact analysis, control path, contract mechanism, evidence, you ensure that every decision is defensible. That is what regulators expect, and it is what the PMP exam will reward. Thanks for tuning in to the Bare Metal Cyber Prepcast, your trusted source for cybersecurity news and insights. Remember to subscribe at baremetalcyber.com so you never miss an update. And visit cyberauthor.me for best-selling cybersecurity books that equip you with expert knowledge. Until next time, stay secure and stay vigilant.